There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.
Hi everyone, today we're going to talk about the truth about Wall Street versus Main Street. There's a lot of myths that circulate regularly, and those myths are surfacing once again as more and more new investors and new retail traders try to trade the stock market. Wall Street, for most people, is some mysterious place or people or situation, they're not really sure what, that controls the stock market and cheats Main Street out of their money. That's what everybody believes. But Wall Street is not one entity. In fact, there is not one entity for Main Street either. There are actually 10 different, distinctly different market participant groups. Each group has a different name, has a different amount of capital reserve or money they can invest, different time length of when they hold the stocks, the reasons for holding the stocks, whether it's fiduciary or personal, the order types that they can use, the lot share sizes that they use, and the venues, the places where they do trade the stocks back and forth, are all completely different for all 10 market participant groups. What you do have and how you should approach it is you have the professional side of the market and you have the retail side of the market. And within the professional side of the market, there are several different market participant groups, each with their own agenda, each with their own order types, each with their own capital reserves, and each with their own venues. And these constitute what you understand to be Wall Street. And we're going to talk about those today a little bit so that you can begin to understand what is going on in the professional side. So instead of calling it Wall Street, let's call it the professional side of the market. Now, the professional side of the market has several different groups. It has what is called the sell-side institutions. The sell-side institutions create the trading instruments by which everyone can trade or invest in the stock market. They are big banks like Barclays or Bank of America or JP Morgan, and they are large financial services companies such as Goldman Sachs, BlackRock, and other big sell-side institutions. These are all very large corporations. It does not include regional banks. It does not include your local neighborhood broker, Edward Jones, or someone like that. It's only the very largest money central banks and the very largest financial services companies that actually are resident in New York or nearby. And these companies create the instruments by which you can buy and sell stocks or stock derivatives such as ETFs, options, and other trading instruments. The sell-side institution is actually, more often than not, what the news media is referring to when they talk about Wall Street feels this. They're talking about the sell-side institutions only. They're not talking about the rest of the market participants of the professional side. We're always going to refer to it as the professional side of the market because that's the division that really exists. Wall Street's just a place, and Wall Street happens to be where the New York Stock Exchange is. But it isn't really an entity or a group of people. It's just the name of a street. Main Street refers to retail people, but we're going to call them the retail side of the market because they constitute individuals and the citizens of the United States and the world who invest in U.S. publicly traded stocks. So we're going to continue with the professional side. The next level is the buy-side institutions. The buy-side institutions constitute mutual funds, very large mutual funds such as Vanguard and Fidelity, and they also have all of the pension funds. The Fortune 500 or the Fortune 1000 corporations that are publicly traded in the U.S. all have pension funds for their employees. They may have as few as 10,000 employees or 1,000 employees all the way up to 50,000 or more. And each of these employees has a pension plan. These need to be managed. And in the 70s, Congress permitted these pension plans to trade the market and invest in stocks to increase the value of those pension funds to cover all of the expenses and so on of the pension fund and to increase the value of the funds holders' monies that they had saved for retirement. So everybody is investing in the market. If you work for a large company or any company that provides a pension plan, whether you know it or not, you're in the stock market. The buy-side institutions take their responsibility very seriously. It is fiduciary, meaning they are responsible for other people's money, and they must invest it in a specific way, which is called a charter. A charter represents the rules and regulations that govern what stocks or stock derivatives they can buy and hold in a long-term investment for you, on behalf of you or the mutual funds or the pension fund holders, for the investing in that particular index or fund that you have selected. When you purchase the mutual fund or when you just chose your pension funds, you get a little list of index funds or different types of funds that you can invest in with a variety of names, and you check that one, and then the mutual fund is responsible for making sure, or the pension fund is responsible for making sure that they hold a certain type of stock, a certain quality of stock in that fund, in that charter, in a trust. So all the stock that they buy goes into a trust where it stays there as a long-term investment until the institution decides to sell it because they need to modify the portfolio or adjust the portfolio to balance that portfolio is what they call it. They control way over $100 trillion to $120 trillion in assets worldwide. So they invest all over the world, and the U.S. giant institutions are the largest in the world. They're massive. They have trillions and trillions of dollars. So there's a huge amount of money in long-term investments in the U.S. stocks and other foreign stocks. So the buy-side institution is actually the most important of all of the professional side. What they are called nowadays by the common man, or what you'll hear often, is they are often referred to as dark pools. Now, that is not actually what they are. That is a name for the venues that they buy and sell stocks on. But the buy-side institutions, also known as dark pools, are the most important investors in the stock market in the world. And our firms are larger than anyone else's in the world, and we have more of them than anyone else in the world because the U.S. has more investments than anyone else in the world. We have the largest stock exchange and the largest stock market with the most derivatives anywhere by leaps and bounds. Buy-side institutions are conservative investors for the most part. Yes, during the 1990s they went kind of speculative, but nowadays they're very serious about what they do. So when you buy a mutual fund, you are buying from the buy side. To quantify and clarify this for you, the sell-side institutions are basically forbidden in their pure essence to sell directly to the retail. The sell-side institutions are supposed to sell their hedge funds and all of their activities to the exchanges or via a route on which you can buy it. Your retail broker, different venues. So they can't actually sell something directly to you. They have to go through the buy side, and the buy side institutions cover not only the giant mutual funds and the pension funds, but it also covers smaller funds, mid-sized funds. These are littler funds. Let's say there's a company that's not a publicly traded company, but it has 500 employees and it has a 401k. It has a pension plan, and someone is managing that. And we have our very, very small funds, which are your local neighborhood retail broker on your corner if he's a franchisee, or maybe someone who's just managing a few $1,000,000 or even $100,000 for somebody else. Anytime someone else is licensed and bonded to manage someone else's money, they're called a fund. And there are many, many tens and tens of thousands of small funds and several hundred mid-sized funds and a few hundred larger funds, and then about 25 to 30 giant funds. So these constitute the buy-side institutions. And within the buy-side institutions, there are different groups. So the smaller funds, mid-sized funds, larger funds, giant funds, they trade differently because they have a different amount of capital base. The giant funds, of course, have the greatest managers in the world, and they do extremely well based on their charters and what they're allowed and not allowed to do. They can't sell every stock when there's a bear market. They have to mitigate those and hedge those losses with alternative derivatives to mitigate that, because they can't sell out of the market. That's one of the rules that they have. That's something you need to be aware of. So the buy-side institutions is a very, very large group that controls a vast quantity of money. It is way more than the world GDP is under asset control by the buy-side institutions. So they're way bigger than the big banks. The banks are not anywhere near that size of control of money. We also have professional traders on the professional side of the market. Now, professional traders come in a variety of shapes and forms. Buy-side institutions now have trading floors, and they have professional traders who spend all day at terminals in a big room all together, buying and selling stocks on behalf of the fund, either for the fund holders or for investing in the fund itself. There are also proprietary desk traders that used to work for the sell side or the big banks. What proprietary means is they are trading the proprietary capital reserve of that corporation. Then we have the independent professional traders who maybe were once floor traders or whatever, but they are licensed and bonded. Sometimes they were stockbrokers, whatever, but they are a professional trader that trades for themselves independently. You won't hear much about them. They hardly ever talk to the news media. They keep a very reclusive life and a very low key, and they make a lot of money because they have been floor traders in the past and they know how to trade stocks short term. Now, the traders group, the professional traders group, all trade for the short term. The mutual funds and pension funds invest for the long term. And the sell side creates the instruments, underwrites the IPOs, all of that, so that the buy side can function. Then there are the high frequency trading firms. These are not individuals. These are companies that have very high frequency computers, the fastest speed computers in the world, hooked directly into the exchanges. And these trade on the millisecond. They can trade 3,000 to 6,000 times per second. And they are trading early in the morning and the first few minutes of the trading day. High frequency trading firms specifically trade for their company. So the computers have algorithms that search for specific things, such as retail traders chatter on social media about a stock, or a MACD crossover that occurs on a stock chart. And then they jump in ahead of retail traders and they trade against them, or they trade against the smaller funds who also trade similarly to the retail investors. So HFTs are predatory. Professional traders are opportunists. They are looking for opportunities. HFTs are predatory. In other words, they're supposed to be a maker-taker, but they may be actually predatory, in which case they're jumping ahead and raising price and then selling as other people start buying. But for now, you want to consider all of these different market participant groups. Also, we have wealthy investors. These are wealthy families or individuals who are worth millions to hundreds of millions to billions of dollars. Melissa and Bill Gates Foundation as an example. These are managed by professionals, and professional money managers manage their money. Their money is in the stock market and other investments. And they are considered professionals because they understand business and they are very, very wealthy. So they fall into the professional side of the market. They're usually long-term investors. They do very little short-term trading. and they behave very similar to the buy-side institutions. The final group in the professional side are corporations. Yes, the publicly traded corporations trade the market. In the last few years, there have been huge, massive buybacks. The corporations have been buying back outstanding shares of stock for themselves. They've been buying their own stock back because that increases the value of their stock. So those are the professional side of the market. And all of them have different venues. A venue is a place where stocks are bought and sold. They buy different share lot sizes. A professional will start anywhere from 10,000 shares to 50,000 shares if they're a small fund. If they're a larger fund, 100,000 up to 1,000,000 shares. The sell-side institutions also have to buy stock to create ETFs because they have to build units of 50,000 units per share that would be traded on the exchange. And they have to put these in trusts. So the sell side also buys and sells stocks as well. So there's a lot going on in the professional side that you need to understand. If you don't understand what the professional side is doing, and all you do is take recommendations or buy whatever some guru is telling you to buy or someone famous that you hear is buying, you're buying usually a very expensive stock. The stock has been moving up for a long, long time, and the business cycle of that stock is probably coming to an end. So you have to be very careful about listening to retail news because the professional side encourages you to buy at an expensive price for the stock so they can sell and profit from it. And it is your responsibility to get a decent and reliable education, something that has the truth in it rather than hype and hoopla. It is your responsibility to understand what you're buying. It is not the professional side's responsibility to educate you, and they're not interested in educating you. They would rather that you simply buy whatever mutual fund they recommend or any pension fund, index fund that they recommend. Because that's how they make their money. They make money on everything that you invest in. They take a cut. They take a percentage to cover the costs of the fund. If you really want to be successful in the stock market investing, and if you want to become financially independent, and it is very possible to do, and it's not that hard, you need more of an education than just going on and reading a few articles on Investopedia or Investor Guide or following some guru's commentary or whatever. You need to understand the stock market. Now, unfortunately, every book out there was written a very, very long time ago, and most of the theories that are out there are completely and utterly outdated. The bulk of the market participant groups started to develop in the 90s. Prior to that, there were only a few market participant groups. It was a much simpler market. It wasn't fully automated. There weren't any HFTs. There weren't any dark pools. There were fewer wealthy individuals investing. There were fewer pro traders. There were no independent traders until the 80s. So it was a very different market. And in the last decade, the stock market has changed more than it did in the prior 100 years. It is changing at an accelerating pace. So you buy some books on investing and trading and it gives you some basics, but it doesn't give you what you need to know to be a successful investor for your pension fund or for yourself or your mutual funds. And it certainly doesn't teach you how to trade stocks if you wish to trade stocks for extra monthly income or full-time as a career trader. So you need to be careful and understand what's going on. That is the whole purpose of TechniTrader. We educate you and give you the facts, dispel the myths, and tell you the realities of the stock market, how to trade it and how to invest. We have only one goal, and that goal is to educate you. We're not a broker. We're not trying to sell you a charting system. We're not trying to sell you a trading system. We teach a trading process that is extremely reliable and consistent because you understand all the variables and all the things that are going on in the stock market, just as you understand your own career. Whatever job you're doing, you thoroughly understand it. You have an education and a background in it probably. You've been doing it for 5, 10, 20, 30 years. You really understand that. And the goal is for you to understand the market at that level. And it is not that hard when you have it laid out. We're educators and we know how to educate. There's a vast difference between somebody teaching you a strategy they came up with one weekend and decided to teach you, and another thing being taught by educators. Also, your charting software company does great seminars, and what they're trying to do is sell you the software. They're not professional educators, and they don't teach you everything you need to know. Most of the time, they just grab any old, ancient, outdated strategy and show you to get you all excited, so you'll sign up for their charting software and they can make money. Meanwhile, you're stuck with a strategy that hasn't worked in 20 years. So if you want to learn more about the stock market, visit our website at technitrader.com and check out all of our learning information that we have there. This shows you how we teach and what we intend to teach you and why it is so important. And then if you feel that you're ready, give us a call and check out our courses and download a course syllabus. Our course syllabuses are an extended, detailed outline of what is taught in the courses. It gives a complete explanation with examples of what you get and what you do so that you can thoroughly understand what you're buying before you buy it. There is no other company that provides this extensive a syllabus so that you can see what you're getting before you decide to become a TechniTrader student. I'm Martha Stokes. Until next week, trade and invest wisely.
There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.